Welcome back. It's Kevin Prince from BMO Exchange Traded Funds. We're so pleased to have you join us once again for the Market Insights webinar. We started this, of course, in the middle of the correction back in March. And, it's really been a pleasure to be able to provide insights to you on a regular basis. Now, this session, we're quite pleased about this, is a direct outcome of some of the questions that came in. Now, I really do appreciate those people who take the time and effort and send us questions, because it really helps us enhance our content and tailor our content towards what you need. And in some cases, we actually build an actual webinar around that. And that's what this is. This is all based around a question that came in around holdings versus exposures. And that's what we're going to spend time to talk about today is, the differences of the holdings versus exposures. And we're going to give you a bunch of examples. So like in our previous sessions, we're not giving advice and not specific recommendations. What we're really trying to do here is give you insights in towards the overall market and specifically around exchange traded funds. Now, joining me here today, I get the pleasure of having Chris McCaney join us again in the session. Thanks for joining us, Chris. And of course, Mackenzie Box too. Great to have you on board and give us your insights for this week. Now, just like in previous sessions, we always like to start these sessions off with a little bit of, tools out there. Now, one I'm going to highlight for everybody out there, and if you haven't gone to it, Stock Charts is a website, stockcharts.com. I really like one part of the website under the Charts and Tools section of the Stock Charts website. There is something called a market carpet. Now, the nice thing about the market carpet is you can choose various different markets. So I am showing you an example here on the right-hand side of the TMX. And what they're doing here, and I think it's very insightful, is they take the respective sectors of the TMX and they're actually showing you those sectors by market capitalization. That's the size of those boxes. And each one of those boxes actually is the sub boxes within inside those sectors. Each one of those boxes is an actual company. And then the color coding there, the green or the red, is showing the direction in which that company is trading at that time, up or down, green being up, red being down. And so what I did here, this is just yesterday itself, and we did a quick little snapshot at the time. It was kind of more of a balancer. You kind of see a light green versus a dark green or a light red. But you could actually even change the time frame if you want. You can go back to different time frames and take a look at different looks. And again, I'll highlight not just the TMX, the US markets there too. Lots of different ways of views, but I like it as kind of a snapshot of what's going on in the marketplace. I encourage you to take a look at stockcharts.com, specifically the Market Carpets website itself. With that, let's get into today's topic. Again, we're going to spend the time on talking about holdings versus exposures. And I start off with Mackenzie here. And Mackenzie grabbed on our website a couple key pieces here, holdings, but also where to find some exposures. Mackenzie, talk to us a little bit about the difference of holdings and exposures and where people can look at to start them down the path of where to get the information on this stuff.
Sure. Thanks, Kevin, and thanks everyone for joining us today. When it comes to ETF holdings, it's always important to look at the respective ETF provider's website to make sure you actually understand what the ETF is holding. Generally, you see most providers post their holdings on their website either on a daily basis, so BMO ETFs we do, but some do post them on a monthly, so it's just something you want to be mindful, especially mid-month, things can definitely change. But the other thing you want to look at when you're looking at these holdings, you always want to dive a little bit deeper and make sure that you actually understand the strategy of the ETF and make sure that you understand how the ETF works and the actual exposures that you're getting. And most providers do post kind of your sector exposures and geographic exposures and whatnot on the website as well. But I think what's really important is providing additional resources that actually dive deeper into the strategy so that you actually understand how the ETF operates and what you can expect your exposure to be for the respective ETFs. So I've included a few different screenshots here of some of the pieces that we have on our public website. So if you are looking at specific strategies, I would encourage you to look around the different ETF provider websites and find those resources that really speak to the different strategies so that you understand the exposure you're getting, as well as the holdings and how the strategy works.
And I think that's key because what we're really trying to talk about here today is that you can certainly look underneath the hood, and that's what you want to do for every ETF out there. But when you're looking underneath the hood, sometimes you need to look beyond the actual holdings inside the ETF, and you can get them updated on a regular basis from as Mackenzie said, from the ETF providers. But take the extra time and understand the exposure, because it can be different than the holdings from time to time. Mackenzie, let's give it a couple of, a basic start off here on a kind of a holdings, somebody to find on the website, but also let's talk a little bit about that exposure. And this is an example you brought up about one of our ETFs that holds another ETF. Walk us through that.
Yeah, so in the last slide, I showed an example of ZSP, which provides exposure to the S&P 500. And in this example, I included a screenshot of ZUE, which is the hedged version of the ETF. And essentially what you're seeing is that the ETF is holding ZSP, which is the ETF we just showed, and a cash component, which is actually your hedged currency contract. So what you'll see is that it shows currently as a negative amount. So currently we've seen USD move up a bit. So we are losing a little bit on that currency hedge, but the currency contract isn't a security. So it gets reflected in the cash component. So also the fact that it's OTC, which Chris will go into a little bit more detail on later on, there's no real way to identify that. So it gets rolled into the cash component. So at the end of the day, what you're really getting is that exposure to the S&P 500, which you saw in the other screenshot, but then you're also hedging out that currency. So you see your currency contract essentially reflected in the cash.
Great point there. We're going to spend a little bit more time about currency in a second. We're going to have Chris cover that off, but it's key to highlight here. While your cash is negative right now because of that currency exposure, keep in mind inside the S&P 500, the securities themselves are not only not just Apple, but it's also the underlying currency exposure too at the same time. So that actually neutralizes each other out. We'll spend some more time in a second, but it is key to take a look underneath the hood. And we're going to give you lots of examples as we go along as we talk about the difference between exposures and holdings. Chris, when we're talking about exposures, I think the key thing to think about here too is the thought of derivatives and the role they play in a portfolio when you're talking about exposures. So maybe we should take a step back before we go into more screenshots on holdings, and maybe you can give us a little bit of background on what derivatives are and where they're kind of commonly used, and then we can dive back into holdings a bit more.
Sure, we can certainly do that, and I think you're right. This, the derivative exposure and what a derivative is key to understanding, the overall exposure of the ETF that you're looking at, because derivatives can be used to either reduce or hedge against an exposure, or they can be used to add an exposure onto the portfolio as well. So there's a couple of different ways derivatives could be used, and there's many different underlyings as well. Just to take a step back and define, what is a derivative? In essence, it's a financial instrument that derives its value from some other financial instrument. So, in contrast to a stock, a stock has value because it represents ownership in a company, or a bond has value because it represents an obligation from a company to pay interest and then a principal back to the bond holder. So those are financial assets or securities that derive value from what it is. A derivative generally references a different asset, and so that's where the value of the derivative comes from. And as you can see on the slide here, that underlying asset could be anything really. It could be a stock, it could be an index, a stock index, it could be fixed income itself, it could be a specific bond, it could be an interest rate number, it could be any commodity, or it could even be a currency or exchange rate. So, any number of different underlying financial securities or assets could be the basis of a derivative and where that derivative gets its value. So in the context of how that creates an exposure within an ETF, you have to understand what derivatives are being used and then what those underlying assets that are being referenced by the derivative are in order to determine, what's my overall exposure within the fund.
Thanks for that, Chris. And I think the key here is that, we're looking at derivatives, they can actually change the exposure is what we're effectively talking about. And for different types of derivatives out there and different exposures, they can really just change it based on the underlying holdings itself. And so we're going to spend some time on that. But, also I want to talk a little bit, Mackenzie mentioned OTC. So maybe Chris, use a terminology. Let's just simply set the stage. Different types of derivatives out there. Let's talk about those too.
Sure, and in the same way that a derivative could have any number of underlying reference assets, there could be different ways in which that derivative is structured also. And on the slide here, we have the two basic examples of an exchange-traded derivative versus an OTC derivative, and the pros and cons of each there. So an exchange-traded derivative is, think about an equity option or a index futures contract. These are things that trade on an exchange. Of course, some of the pros there are enhanced liquidity. When you're trading on an exchange, you're interacting with any number of financial market participants. There's transparency into the price. You can see the price on the exchange as you're about to trade it. You know what you're going to be paying, and the contracts are standardized as well. So, again, when we think about an equity option, generally one option contract equals 100 shares of the underlying, or for a future, those values are defined as to what one contract represents of the underlying asset. As well with an exchange traded derivative, there's no counterparty exposure. You are trading on an exchange, so that the exchange is the clearinghouse and the settlement process happens there. Contrast that with an OTC derivative, which stands for over the counter. That's really an agreement between two parties. So, it's not the same as interacting with everyone on an exchange. The fund or whoever's using that derivative would go directly to one other counterparty to create that derivative. The benefit of that there is that it's completely customizable. Every element of that contract can be customized to your own specific needs. Should the exchange trade equivalent not meet exactly what you're looking for, you can go to the OTC market. Of course, again, there's less transparency there. Operationally, it can be intensive as well, that settlement process. And then, of course, you are also taking on counterparty risk, which with whatever counterparty you're trading with, there's no exchange in the middle and no clearinghouse. So that's just some of the pros and cons of each. And as Mackenzie mentioned, in the terms of ETF holdings and holdings reporting, an OTC derivative by its very nature is really just an agreement between two parties. So it's not an asset that can be easily identified and defined and listed in the holdings of a fund. And so, there can be, as she mentioned, it does kind of just get lumped in with the cash and cash component. So, in that case, you might have to do a little bit more digging to determine, what derivatives are being used here in the context of the fund, and how does that alter the exposure. Typically with exchange traded derivatives, it's a little bit easier to define what they are and list them out under the holdings.
Well, let's take a look at those. I think we got an example coming up, but before we go into the example, I want to go back and just close off on the currency one first, right? Because I want to make sure we help everybody understand what is effectively going on here when we talk about a currency hedged ETF. And Chris, maybe you can set the stage on that first on the currency hedge, because this is almost kind of a partial derivative being used here. So walk us through that.
Yeah, sure. So if you think about a Canadian investor, when a Canadian investor buys any stock, and we're using the Apple logo here, so let's just assume we're buying an Apple stock, but really any stock that trades outside of Canada, a Canadian investor is picking up two different return streams. They're going to pick up the return of that underlying stock. If Apple goes from $100 to $110, you get that benefit. But because you're a Canadian investor, there's also the movement of the US dollar versus the Canadian dollar. Because at starting point A, if Apple's trading at $100, those 100 US dollars are worth a certain amount in Canadian dollars. The next day, those $100 US are going to be worth a slightly different amount in Canadian dollars based on where that exchange rate moves to. And so again, you're getting two different return streams when you buy, on our screen here, we have ZSP as the example. When you buy the S&P 500 as a Canadian investor, you are picking up the return stream of the equities as well as the currency exchange rate. So what an investor can do is, instead of buying ZSP, which is what we call our unhedged ETF, the investor can buy ZUE, which is hedged back to Canadian dollars. And what we're doing there is using currency forwards to essentially eliminate the underlying fluctuation of the exchange rate. And so what that is doing is isolating the return of just the stocks themselves. And so, you know, really, depending on your view of what that exchange rate is going to do over time, that will help define which of those two funds you would want to invest in. If you think the US dollar is going to go up relative to the Canadian dollar over time, you would buy ZSP. And if you think the Canadian dollar is going to go up in, relative to the US dollar, you would want to hedge out your currency exposure, and you would buy ZUE to do that.
Of course, in my thought process too, if you just don't want to worry about currency, then you go to ZUE too, right? If you want to participate in it, think about ZSP.
Yeah.
Let's go forward, because that's a good example of kind of almost a partial use of derivatives, because that's just changing the currency, right? Now let's move into where it's actually now becoming part of the actual exposure. But before we do that, I guess we should talk a little bit about time decay, because now we're talking about exchange traded, where people are putting money up. So walk us through what time decay means across the board here.
Sure, and now we're moving into the arena of options, and you know, typically we use a lot of equity options at BMO, but really options could be, again, based on any underlying asset. But one element of an option's value, there's two elements of an option's value. One is the intrinsic value. So, you know, if I bought a call option with a strike price of 50 and that underlying stock is already trading at 51, then that option has an intrinsic value of $1. You can earn $1 right away by exercising that option. But any value over and above that intrinsic value is referred to as time value. And what that represents is essentially the wide range of outcomes that can happen before that option expires. And so the farther away you are from expiry, the more time value an option has. But as this chart shows on slide 10, it's not really a linear function. You know, 12 months out, you might have a certain amount of time value, you know, obviously higher than if it was only 1 month away from expiry. But as that option moves day to day, closer to the expiry, you're going to lose a little bit of that time value. And that's what we're referring to as time decay. So again, think about an option that's 1 year to expiry. Let's assume 1 day goes by, nothing changes. The underlying price doesn't change at all, but you're 1 day closer to that expiry. You're only really going to lose a little bit of time decay, because there's still a wide variety of outcomes that can happen in a year. But now fast forward to, let's say, 2 weeks before that option expires. If there's only 2 weeks left, that range of outcomes that can happen before expiry has narrowed significantly. And each day that goes by, again, that range of outcomes narrows significantly. And so the time decay, as you get closer to expiry, really, really speeds up. And, you know, this is something to keep in mind if you do invest in options yourself. Typically, when you want to, if you buy options, you want to buy longer dated ones, so the time decay isn't too punitive. And if you sell options, you generally want to sell closer to expiry, so the time decay works in your favor. But just in the context of looking at, you know, the holdings of an ETF and determining what the exposures are, you know, if you see options in there, generally you can see when those options expire, and it'll give you some idea as to the time value left and how quickly those options will start moving based on time decay.
Thanks for that, Chris. It's a good foundation too as we move into those options. Now, let's talk about, because we had again that we had the initial conversation around options and derivatives for that matter specifically, in around ZSP and ZUE, and it's kind of a partial exposure. Now we're talking about, so let's start talking about a full exposure. So I'm going to go right to here on a fixed income. The full exposure, and bear with me, and I think people might help, is here's the holdings on the left-hand side. And the bottom of the holdings on the left-hand side, what you're seeing is a CDS contract of 7%, but you're seeing a lot of Canadian fixed income T-bills and that kind of stuff. Now, Chris, when somebody would look at the holdings here, they might think they're holding lots of T-bills, but maybe you want to walk us through the holdings versus exposures here for this ETF, where it's just one a little bit more use of ETF, but full exposure towards the ETF, not doubling up yet, but just full exposure to the option. Walk us through that.
Sure, and I think you can start to sense a theme here when you see holdings that are 90+% T-bills or cash equivalents. Typically T-bills are held as collateral for a derivative, and so when you see a 90% cash or 95% cash or T-bills in a fund, generally that's a clue that there is underlying derivatives going on, and you can take a closer look as to what the exposures are. This particular ETF is our ZFH, ticker ZFH, and what this one does is it does hold those T-bills again as collateral, but it uses a swap, which is another form of derivative, to gain exposure to high yield credit spreads. And so in essence, you have that 90, as you can see on the chart here, a 90-day T-bill yield is your underlying investment, plus whatever the spread is on the high yield index of the swaps that this fund is holding. So you're getting a T-bill plus type of return. And the chart, the screen grab below it, shows that even though this fund shows as 95% cash and T-bills, the return experience is actually quite different than just owning T-bills. I think it looks like about 3.5% annualized return versus just under 1% if you're only holding the T-bills. And obviously that changes quite a bit over time based on what that high yield spread is doing. So again, you have to take a look at within the holdings, and they're actually listed here. You have T-bills at the top, and then you have a bunch of different CDS contracts or CDX contracts, and these are the swaps I'm referring to. If you looked at the bottom of this holdings list, you would see a bunch of negatives as well. But quite often, a derivative itself has very, very little market value. And in this case, simply the way they're reported, we have pairs of contracts. One has a high value and the other has a very low value. And when you net them together, it's very, very low. So typically derivatives do not have a high market weight, market value within a fund. It's just the gain or loss on that derivative that's reported as a weight within the fund. And so that's why you see, funds that hold or the entire exposure of the fund is a derivative. You'll see almost all of the market value being in cash and T-bills and cash equivalents, and only the gain or loss on that swap or on that derivative is reported as market weight within the portfolio. And in this case, looks like about 5%. So again, it's just something to take a look at. And as we've said before, a high amount of cash and T-bills is a clue that there are other things going on in that portfolio, particularly when you see the return stream going quite differently than just what a T-bill will give you as well. So again, something else to take a look at. We think this is actually a very interesting fund that gives you, no duration exposure, very, very little duration because you're only holding short T-bills, but it gives you the pickup on credit spreads by using the CDS. Quite often, funds also use derivatives because the market for them is very, very liquid. In this case, the CDX market actually more liquid than the underlying bonds themselves, the high yield bonds themselves. So by using derivatives in this case, you're enhancing the liquidity of the portfolio, and you're structuring it in a much more specific way than you would if you just had to go out and buy some specific bonds. So just one of the benefits of using derivatives to create an exposure within a fund.
And I really like the chart there because effectively you can clearly see there the orange line, the T-bills, which is the bulk of the holdings as you'd normally look at from a holding aspect, but you can clearly see the exposure to the high yield market, hence the fluctuation in price movement on the actual ETF itself, the ZFH. And again, your good point to say, this is kind of your one for one for your almost all your exposure is coming from the derivative contract, even though your holdings are a bit showing more T-bills in that case. Right. Now, Chris, let's go into a little bit more because this is example one, and of course, from time to time we get other questions in coming on like double leveraged, right? So now somebody's got not just one-time exposure, they got almost like a double exposure to the underlying. So walk us through this, and maybe more importantly, the exposure aspect of itself, because these are really designed to be more short-term instruments. I mean, that's kind of the key thing I want to highlight in these exposures. Walk us through this a little bit.
Sure. And so, yeah, these investments are structured very similar to what you would see in the previous example. It's just that the swap they are using gives extra exposure, so to speak. So they would hold T-bills or some other investment and swap it with an investment bank in order to gain the exposure here. And essentially what you're seeing is the red line is just the BMO S&P 500 ETF. That's your plain vanilla S&P 500 index. And the blue line is the levered ETF. So it provides a 2 times exposure to what the underlying investment gives you. The key here, though, to understand is that double exposure gets reset every single day. So if you go up 5% in one day, that ETF will go up 10%. But then that double exposure is reset. So if you go down 5% the next day, that ETF is going to go down 10%. So on a day-to-day basis, they will give you that double exposure. And because of that daily reset, these are really used more as trading vehicles rather than investment vehicles. So an investment vehicle is something we think of as a buy and hold investment. You buy the S&P 500 over time, and hopefully it goes up over time. Because of the nature of how these leveraged ETFs work, because of that daily reset, generally, if you held it for a long period of time, the total return you got is actually quite path dependent on how you got there. So, if you held the S&P 500 for 1 year and it returned 10%, that double levered one is not going to give you 20% over 1 year. It'll depend completely on the ups and downs it took to get there over the course of the year. And in general, over time, quite often you'll lose value because, going down 5, you have to actually earn double to get back up. And so because this fund magnifies the down days just as much as the up days, generally over time, it would be a negative experience if you held it over the long term. But over the short term, again, 1 day or even, a few hours or a couple of days, these things can be very useful, again, as more of a trading vehicle, not an investment vehicle that you buy and hold over time, but as a trading vehicle to add on exposure quickly and then take it back off very quickly as well and very efficiently. And again, this is a way that a swap is used or a derivative is used to create an exposure. So in some cases, we've seen we're using derivatives to reduce an exposure, like that currency effect. And in this way, we're using a swap to gain exposure and in fact gain double exposure to an underlying reference asset.
Thanks for that, Chris. And it's all about exposures here. And you're certainly seeing that the longer time period you're holding this is giving you a different exposure than maybe you think it's doing. So again, think about the time frame for these kind of solution sets. Moving a little bit further here, because one of the key questions we do get also too, and more recently, is around ZPAY. And so this is a quick snapshot of some of the holdings inside ZPAY itself. But what I want to take you into now is not just the holdings as I showed you here, but simply touch base with Chris and talk about the exposures that ZPAY offers. Because when the initial question came in, they started looking at the underlying holdings, and you might have seen a little more fixed income, as we mentioned before. But is that the actual exposures you're getting? So Chris, walk us through the current exposures of, for example, ZPAY itself. And for everybody out there, if you don't know what ZPAY is for an ETF, it actually is an ETF. It's kind of more of an alternative ETF to the basket, kind of more of a complement to a portfolio. Walk us through that, Chris.
Sure, and again, on the holding slide that you had there, again, we could see 68% in T-bills or whatever it was there, but 67% in cash and equivalents. Again, just a signal that likely derivatives are being used here. And in this case of this fund, we're using equity options. You can see the top holdings there are plain vanilla stocks. So we do own an element of stocks in this portfolio. About a third of the portfolio, as you can see, they're 32% invested directly in stocks. But the rest of that portfolio, the T-bills that are held are used as collateral for short put positions, and we're selling equity options in this portfolio. And essentially what we do is, we own a bunch of stocks, a basket of US equities that we like. And instead of just buying them outright, we buy a piece of them, we buy a little bit, and then we'll write a put option to earn some premium. We write put options on every single stock that we own in this portfolio. And the idea behind it is, we sell a put to gain a premium. This fund is called the Premium Yield Fund. So we're gaining a premium by selling that option. And what that option does is it'll obligate us to buy the stock at a strike price, the strike price of the option, which is typically lower than where the stock is trading today. And in normal circumstances, that's 8, 10, 12% lower than where the stock is trading today. The other thing we do in this portfolio is on the equities that we do own, we sell covered call options as well. And many of you might be familiar with our covered call strategy that we employ across many of our dedicated covered call ETFs. But what we're doing there is selling call options to, again, earn more premium. And in this case, if the stock rose or went up in value, that option would get assigned and we would sell it away at that strike price. And so what this strategy does is it uses, it's using put options and call options. So a couple of different derivatives here to create an exposure so that you can earn premium, but also buy stocks as they get cheaper. So as they sell off, those puts go in the money and you buy stocks as they get cheaper. And then as the stocks go up in value, you're selling them away through the exercise of those call options. So you're buying low and you're selling high. And on both sides, you're actually getting paid to do it because you're selling an option on each side as well. So we think it's a really interesting way to gain partial equity exposure and still get this consistent earnings cash flow stream from this option overlay that we're running. And there's the chart that shows what's going on in the two sides of the portfolio. So again, on the side that owns T-bills, in the holdings is referenced as T-bills. There's put options being sold against those, and that actually creates a little bit of equity exposure because you're exposed to the downside of those stocks. And on the side where we're just owning the stocks themselves, call options that'll generate more cash flow. And you can see for this fund, when you put them together, the annualized option yield in this table at the top, you're getting 5% on the puts, 5.2, and then 2.1 on the calls. That's over 7% on an annualized basis that you're earning, in addition to whatever those stocks do. So if the stocks go up or down, you're getting that return as well. And then of course you're also getting dividends out of those equities that you own, and you're getting a little bit of yield on T-bills. It's not very much these days, but all in, you get a portfolio that's yielding about 8% at a gross level, before fees and commissions and things. And still gives you some equity exposure as well. So we think it's a great way to combine different option strategies to create these exposures and earn a very high level of cash flow while hopefully also earning a little bit of growth out of the equity market.
Thanks for that, Chris. And I'll also highlight too, on the public website for BMOETFs.com, you will find an actual detailed publication that goes into this, showing the same graphic there. But yeah, I think it's really key here, and I thank you for that, Chris, kind of highlighting the difference between that T-bill you mentioned right off the bat and what the real exposures are you're picking up here. So thanks for that. So with that, let's shift gears. Got a bunch of questions that came in. So this first question relates to, of course, the topic you just came from, Chris, talking about how the ZPAY works. Thanks for that. I think the real next part of this question I want to spend time on is, is the strategy more focused on dividends or price appreciation? Can you give me the difference there? Which one do you think is more focused on?
Sure. And so, yeah, timely question, I guess, since we just kind of ran through how that fund works. And, as you can see, it is more of an income-focused ETF. Generally, you'll have less than half of the portfolio invested directly in stocks. And it's all about that cash flow, those premiums that we're earning from selling the options. So I think you could expect, for the most part, a good chunk of your return to come from that monthly distribution, to come from those premiums that we're earning, and a little less so on the growth. But certainly we do hope the stocks that we hold go up over time, and so that there is an element of growth coming out of this portfolio as well. But it probably is premium cash flow first, distributions first, and then growth second. And then also I see in this question, what kind of role does it play in the portfolio? Well, it is obviously for those investors looking for income, especially tax-effective income. Those option premiums are taxed as capital gains, so it's not interest income. It's the most favorable tax rate. So you get a high level of cash flow. You get a very tax-effective mechanism as well. And we think it's something that could slide right into a balanced portfolio because it works well both with bonds and equities. And the overall exposure adjusts up and down over time based on the movements of the equity market. So it almost helps to, again, add right into a balanced portfolio and tilt it up and down as the markets move.
Thanks for that, Chris. Mackenzie, let me bring you back in. Question coming here based on our last session, which had the NASDAQ on. Really, individuals looking for a cost-effective way to, buy the NASDAQ. And it dives into a little more detail, saying, NASDAQ versus maybe an active managed ETF. Is there a cost difference there? And then last but not least, maybe is there a dividend element? Maybe you can answer all three of them there.
Yeah, sure, Kevin. And I think I mentioned last week, there are a few different ETFs in Canada that you can use to access the NASDAQ index. So BMO, we have two. We have an unhedged, and hedged. So ZQQ and ZNQ. iShares also has one, and then there are some in the US. Just if you are looking to the US, you want to be mindful of taxes and your currency conversion. And when you do look at, an actively managed ETF versus a more passive strategy, you are going to definitely pay more for that. Getting that active management normally does come at a cost, so you will see a difference in the fee. And then if you're looking for, a NASDAQ ETF that pays dividends, I think really when you look at the NASDAQ as a whole, you really want that to be as like the growth element of your portfolio. So last week we gave some examples of different portfolios, but having those growthier names in your portfolio will kind of give you that growth, and then complementing that with some more income. We do pay an annual distribution, so it's not a monthly dividend or anything that you're getting with this, but more of a complement to a portfolio being the growth element.
And if you're looking for some ideas on that, we did have a webinar last week where we actually gave out initial ideas of growth and income, mixing kind of the NASDAQ together with maybe some dividend paying solution sets or some power call sets. So take a look at that last webinar I ran last week. Chris, probably the last question we're going to be able to get today. And again, I appreciate everybody taking the time to send questions in. We're going to certainly cover them next week. Gold certainly being big topic for a lot of individuals out there. This individual certainly wants to take a look at capturing inside an ETF, both the bullion and the miners. Don't know if maybe give us some background that explains, and if that exists as an ETF. And then second of all, what's the benefits of holding both?
Sure. So when we talk about gold as an investment, there is gold bullion, which is the metal itself. And there's various ETFs you can use to invest in that. A couple listed in the US are IAU and GLD being the most popular, I think. And what happens when you buy that ETF is you actually buy ownership in physical gold that's stored in a vault somewhere. So you have claim to specific gold bars. And as the price of gold goes up and down, that value of that ETF will go up and down with it. In terms of gold miners, that's more of a traditional equity investment, whereby you buy stocks or you buy an ETF that invests in stocks that are involved in the mining and production of gold. So to my knowledge, I don't think there is one ETF that actually combines those two things. You can generally have one or the other. And we certainly offer a couple that do have exposure to the gold miners. ZGD is our equal weight global gold ETF, so that invests in the gold miners globally. And we don't have one that invests in bullion directly. But the difference between investing in those two things really is, obviously, again, when you're investing directly in gold bullion, the value of your investment goes up and down directly with the price of gold that you can sort of watch and follow. If you invest in an ETF or a portfolio that invests in gold miners, what you're hoping for is a leveraged exposure to that gold price. And so, companies that mine gold can actually go up in value much more than the gold asset itself can. Of course, the risk you take on is that equity level risk, that execution risk. Can these companies actually go down, dig for gold, find gold, pull it out of the ground cost effectively, and refine it and move it on? So, that's the risk that's involved. And so you have two different return streams, one that will track gold very, very closely, and the other that, again, would provide more growth potential than what gold price itself can do, but also adds on that equity level risk that's typical of any other equity investment.
Perfect, Chris. Thanks for that. And thank you, Mackenzie, too, for joining us. And thank everyone else out there for taking the time to join us today. I won't get a chance to go through all the questions, but I do want to encourage you to come back and join us next week. We're going to take the time and effort at the exact same time, 1 o'clock. What we're going to do is we're going to talk about dividends, and specifically dividend-based ETFs, and understand the different choices out there and the key considerations behind them across the board. So we look forward to you joining us next week right here at 1 o'clock. Have yourself a good week ahead. Cheers.